Welcome to the Financial Planning for Canadian Business Owners podcast. You will hear about industry insights with award-winning financial planner and entrepreneur Jason Pereira. Through the interviews with different experts with their stories and advice, you will learn how you can navigate the challenges of being an entrepreneur, plan for success, and make the most of your business and life. And now, your host, Jason Pereira.
Hello and welcome to the Financial Planning for Canadian Business Owners podcast. I'm Jason Pereira, your host. Today I have Keith Foot with me, CEO of Ralph Moss Insurance. And what we're going to talk about today is employee benefits plans, the different components of them, and some tips on basically how you can contain cost. And with that, here's my interview with Keith. Hello, Keith.
Hi, Jason. Good to see you.
Keith, good to have you in. So thank you for coming in and taking the time. Before we get started on today's topic of group insurance, let's just tell everybody who it is you are and what it is you do.
What do? I wear many hats.
Yes, you do.
You know, I was once told that what is your business? What business are you really in? So I always tell people I'm in the business of employee benefits. That's pretty boring. So what we tend to say is that we're in the business of helping employers provide financial security to their employees in times of need. So that begs the question from you. How do you do that? What is that?
Yeah, so what is that? Absolutely.
Exactly.
Way to feed me the question.
So that's my elevator speech, for example,
Yes.
is that we provide financial security to employees, assisting employers at time of need.
Okay, excellent. So basically, we're going to be talking about the group benefit space, which provides that. So let's talk about the why people do this, because many listeners, of course, may already have plans in place or may be considering it. So first off, the reasons we do this are pretty straightforward, but let's hear it from you.
Okay, well, there's many reasons. Unlike the U.S., whose benefits and healthcare system is totally different. In Canada, most of our healthcare is covered by the government. We're pretty lucky that way. So the group employee benefits, the traditional benefits that you think of, the life, the health, the dental, the accidental, the death and dismemberment, disability, they really round out the government offerings because we have CPP and we have unemployment insurance. So we're rounding out those things that the government doesn't cover. So in the case of life insurance, there's a death benefit under CPP. But it's nowhere near enough to cover anything. So the group life insurance would cover off that portion of it.
Yeah. I mean, the biggest one always is two things. Well, disability one, and then also drug plans. I mean, there's discussion of having a national pharmacare program, but we'll see if that ever happens. But yeah, I mean, you see some of the cost of medication, and they're pretty astounding.
And that's not going to abate, unfortunately, with biologics coming in and the high cost of drugs and medications. Well, there's two things to that. We've jumped the gun from life and AD&D and disability straight to health, which is by far is the biggest mover for people, but it's also the biggest cost driver in your health plans today, in your group benefits plans today. And
so we'll come to that. We're going to go down one piece at a time. But so from an employer standpoint, of course, we're providing a solid benefit. We're also doing so in a tax efficient manner because end of the day, if you pay a highly paid employee another dollar of income, they're going to lose 40, 50, 53%, depending on the province they're in, to taxes. Whereas something like this, the entire group basically can benefit to a larger degree than they would if you were to pay that dollar.
100%, 100%. Yeah, I mean, any dollar the employer pays out in benefits is a total write-off to the company. Exactly. And the employee gets the benefit tax-free, with the exception of life insurance, where there is a tax on the premium as a taxable benefit. And with disability, depending who pays the premium, then the benefit is taxable.
Which we're definitely going to talk about that there, because I hear so many misguided opinions on that one. But so before we go any further, so I mean, in the traditional terms, we always talk about attracting, retaining, and rewarding. So before we get started on that, we're going to talk about, I want you to give me a ballpark. So someone comes to you for a new group and says they want to kind of start off in a new group. What kind of cost they're looking at as a percentage of salary, of payroll?
Well, it depends who you ask. I believe it was Robert Half. They came out with a survey where they said that benefits is 35% of payroll. That was their survey. But that encompassed CPP, EI, the whole gamut of including employee benefits.
Which in their own right are like 5% plus, right?
Yeah. But our own surveys of our own client base, et cetera, that we've done I've been in business for over 35 years, we see it averaging about 10% of payroll. What does that mean in real dollars to an employer if he comes to us and says, I want to put a plan in, what's it going to cost? Well, every group is different. You have different demographics, different industries, different number of employees on the plan. But as a ballpark figure, you can estimate that benefit program with life accidental death, dismemberment, some form of disability, some health, and some dental without any other ancillary benefits would be approximately $3,000 to $4,000 per employee per year, which is a good ballpark figure.
And I've seen similar numbers of that in my own practice. So one of the myths I want to dispel before we get started on a kind of a benefit by benefit analysis on this is the myth that this is kind of like people treat insurance like it's free money. And as the employer, if you've been through one renewal, you know it's not. End of the day, this is money to an insurance company who's going to pay for all these benefits, take the taxes and the associated fees for managing all this. But really, I mean, they're hoping to keep some of this, right? And the term for that's called what? A target loss ratio, right?
Loss ratio, yes.
So what are we looking at? Small groups versus large groups. What kind of target loss ratio can they be looking at?
That's really a difficult one to answer because every insurer has their own expense factors.
Yes.
And again, you're talking about fully insured plans. There are plans where there's no insurance company involved.
Correct.
Administrative services only, or AKA ASO.
Which we'll talk about.
It's another animal. So it's not as clear cut as that. But our job as a consultant is to allow the insurance company to make money. Because if they don't make any money, we don't have anyone to insure our clients or insure the companies. But our job is to let them make money, but to make sure that they're not gouging at the back end and that the plan is priced correctly. So to put that into context, if you have a bad year on your health and dental plan and the insurer comes to you with an increase of 20% or 15% or 10%, we go back and we do a complete analysis of all the medications or drugs that have been paid out through that plan, look at that, and then come back with a counter offer to the carrier. What the carrier is trying to do is that if they did not meet their target loss ratio, so let's say, for example, their loss ratio is 82%.
So they're trying to hold on to 18 cents on the dollar.
For every dollar that you pay in premium, they want to pay out no more than 82 cents on a claim.
Yeah, and so they keep 18.
Exactly.
And to be fair, part of that is also taxes associated with the premium, taxes, fees, expenses. So this is not 18 points to the bottom line of the dividend.
Exactly.
Right? Yeah.
It's their expense factors, right? So if they don't meet that, what's on a fully insured plan we're talking about now, which is pure insurance, when they come with a renewal, they're not trying to recoup what they lost. All they're doing is taking a look at your experience. You claimed $100,000, but we only collected $98,000 in premium. They're adding on inflation trend. On health right now, it's about 11.2%. On dental, it's running about 9%. They're adding on, they're looking at the utilization. What's the increase in claims? What's the increase in your employee population?
Trying to figure out the trends.
And they're projecting that in the next 12 months, if your claims stay the same person per head with those factors added onto it, that they would need $115,000 in premium to cover off those same $100,000 in claims. So
at the end of the day, all they're trying to do is make sure. And when I talk to clients about this, I say, look, the honest truth is that in a world with time machines, this would be perfect because they would know what you would spend, travel back in time, and price accordingly with their amount over. But this is why renewals happen. Renewals happen because they make the best guess they possibly can, and then they adjust. But they also, let's be honest, they come back with price increases that sometimes aren't fully justifiable. At least in my eyes, like we go back and negotiate these things, right? And it's very important you have an agent sitting in the middle doing that for you because otherwise that can just compound.
Well, that's
over
part
time.
of our job. I mean, the carriers also have various modalities of doing a calculation or renewal calculation, depending on the size of the group. Like, for example, a group of 10 lives is not going to have the same modality as a group of 100 lives. 10 lives, they will take your group and pool it with all the other groups of 10 lives, look at the experience of the claims of the whole block and rate you according to that. So although your claims may be way below the TLR, they may have paid out 60 cents on a dollar, but when they look at the whole group of 5 or 6 or 8,000 or 10,000 lives, you're now blended in with that. So you get an increase that really is not attributable to your own claims.
So the people don't realize is almost like there's actually levels of insurance on the insurance, right?
Exactly.
Like if you go beyond a certain threshold of claims, that goes towards, it's a charge towards the giant group, not just your group. As you said, you're being pooled in together. So the good thing is that, if you have a terrible, terrible year and you're double what you should be, you're not going to be double on the increase.
It's a form of rate stabilization. But again, our job as consultants to look at that increase and say, okay, we know that, Jason, your group this year, your claims were well within the target. You should not be, if you were standing alone, you would not be getting that kind of an increase. We then go back and negotiate that back with the carrier. And again, that also looks to our block of business with the carrier and our relationships with the carriers. And that behooves you as a client to say, okay, if I go directly, I can go direct as a client to Great West Life, Sun Life, Manulife, any of the companies, and buy the benefits directly.
But when renewals come back, like you don't know what's what.
Exactly. There's no so when the group rep comes to you and says, okay, Jason, you've been with us now for 2 years, your increase is 26%. You have no way where the Manulife's rates are valued in the marketplace.
Short of getting on the phone and calling them all up, as opposed to having an agent do that for you and negotiate for you and then shop the market when it's necessary.
Yeah.
So, okay. So let's go through, one of the big concerns amongst clients, of course, and you just kind of hit on one was cost containment, right? Like you don't want these things getting, when we hear trend rates in the double digits, like no one wants to be paying double digit increases on what's already 10% of their salary on a regular basis, right? That compounds very quickly. So part of cost containment is not just usage, but how you design these plans. So we're going to keep that in mind as we go benefit by benefit. But we're going to go benefit by benefit, and we're going to explain what it is, how much you can expect to get coverage for, or what your options are. And then, is this enough for your client or for your employee? Like, should the focus be there? And we'll just kind of add some color around that. So let's start off with the most basic one, life insurance. So everybody's entitled to life insurance, and it's a mandatory benefit under group plans, correct?
Correct, yes. If you put a group plan in, you usually cannot put in just health and dental. The carrier looks for the benefits where they can make some money as well. Let's be honest, right? And they kind of look at that spread of risk. So most
at the same time, employees appreciate the fact they have life insurance at work.
Yes, but especially if they don't have anything else. I mean, it's usually guaranteed issue. There's no medical questionnaires. So if
up to a point.
So if you've got an employee who's sick and couldn't get coverage by himself, being part of the group, he can get it will be minimal coverage.
But it's something.
And traditionally you'll see, depending on the type of class, I use the word class very loosely. Class not as in class structure as uppity, but class being executive level.
What's interesting? They've done surveys on millennials when it comes to benefits, and the term class plays so poorly with them that you're seeing a lot of the startups in the space start to refer to them around other things like hives and whatever else. It's it's amusing.
But insurance, we still use the word, what classification is what it's short for.
Yes.
So you'd have the executive level, one classification, maybe the office staff, a classification B, a warehouse classification C.
They can all have different levels of benefit.
Exactly. So you'll see traditionally, usually at the classification of executive levels would have higher life insurance amounts, maybe 2-3 times annual salary.
Yeah. But we're typically looking, the options are typically flat sums. Like 5, 25, 50, 100, or multiples of income.
Of income, correct.
Right. And typically, what's the biggest we typically see on something like this? Like $500,000? I don't think I've seen bigger than that.
Yeah, usually on life, I mean, we have some groups, we've got a couple of groups that there's only 10 employees and they have $500,000 of life insurance on the executive level, which is pretty rare. Usually you'll see about 200,000 will be the cap. When you get into companies with 200, 300, 400 lives, then you see the higher maximums available. Again, it's because of the spread of risk.
Absolutely. And on top of that, I mean, the pricing on this is also due not only, is largely based on the average age of the group, right? So that younger groups can afford larger ones at lower cost, whereas older groups, it's the opposite.
Yeah, well, it's actually it's a blend actually. It's a blend of the mix of male and female.
Yes, that too. Gender also matters.
Gender matters, and also the age bands that they fall into. That's how they calculate the rates based on the mortality tables.
Now, I will say I do have a mixed opinion on this, being an individual financial planner, because when I hear, I already have a benefit at work, it's like, well, first of all, work didn't check on your life to see, is there sufficient insurance in place, right? So I always encourage, more often than not, we don't encourage people to rely on this sort of thing. Also, let's face it, these things can change. They can change employers. Like these benefits don't follow them. So this is not, I would say in most cases, this is not a full replacement for standalone life. This is, especially when they're younger, it's a great benefit to have because odds are they're not going to go out and get it elsewhere. But more often than not, people need well beyond what's offered on a basic life policy at an insurance company, through a group plan. And oftentimes this is also offered to the spouse as well as a spousal benefit.
Correct. The thing with group insurance, life insurance to remember is that it's not portable.
No,
when the employee leaves, if he's got 100,000 of coverage and he leaves the company, it's gone. There is a conversion option in all group policies.
But they may be subject to health.
Where you can convert that policy to an individual policy at the then going rates.
Which are not necessarily great.
Depending, if I'm leaving the company at the age of 55, term rates for someone age 55.
Well, compare that to the average age of the company being, say, 30-something, right? Now you're paying a much higher rate. And there's also caps on how much they'll issue to you without a health.
Exactly. Plus that, now I'm paying the premium personally, which is out of after-tax dollars.
Exactly. So they'll also offer spousal benefits, like I said, typically a flat sum,
usually
and also child's benefits, but those are usually pretty small, like $5,000.
Yeah, you usually see it's called a dependent life benefit, and it's an adjunct to the employee life, and it's usually 5,000 child, 10,000 spouse. We've seen it as low as 2,500 child, 5,000 spouse. It's really a nominal amount. It's usually in the range of
final expenses type amount.
$2.36 a month is the usually average premium you see on something like that.
So an employer would it's a
giveaway.
Yeah, so it's a giveaway. It's kind of a final expenses. Unfortunately, someone passed away. Here's some money to deal with those expenses.
Right. Now, what you can do, though, a lot of plans are also what's called optional life.
Yes, so exactly.
Which is the employee can buy up the life insurance themselves and pay it through payroll deduction. Okay. Now, again, depending on the company you're purchasing it from, some of those are portable. We have a product for our clients, which it's optional life, payroll deducted, but if they leave the employer, they then take that coverage with them through to age 65 and pay the premium annually at the same rates as if they were still part of the group.
Yeah, but and like I said, those are all wonderful when they can leave. But again, we can't, whenever doing planning for people, first of all, employers, you have to offer this benefit. Secondly, it's a good thing to offer your employees, right? Especially helps take, the good thing, when I say, one of the things I talk about when it comes to benefits is it's being a little bit paternalistic, quite honestly. You're doing things that maybe they're not going to be diligent enough to do themselves, and they'll be thankful when they're there. So life is one of those things. They may not take the time to go out and get the proper life insurance, but at least they have something through work.
Well, you find you use the word paternalistic. That's when we sit down with a prospect or a new client, even our existing clients every year, we ask them what's their corporate culture? What's the reason for putting benefits plan in? Do they want to be paternalistic and take care of their employees?
Or they want them to stop complaining?
Or they just want to, do they just want to be able to say,
check the box?
Do they just want to say, we have an employee benefits plan?
Yeah.
Totally. So depending on your reason,
yeah,
that's going to drive the plan design and the pricing.
I typically encourage them to be paternalistic because then you design a plan in the best interest of the longevity of the employee. Anyway, that's just another point. So let's move on to the next benefit, accidental death and dismemberment. So describe how that works.
That one's really, again, a giveaway. That will pay, we used to call that double indemnity. So if you die from an accident and you have a life insurance of $100,000, then the accidental death and dismemberment is also $100,000. Mm-hmm. So you would then, not you, but your beneficiary would get $200,000.
It's much cheaper than the life insurance.
It's usually in the range of 2, 3, 4, 5 cents per thousand of coverage.
Yeah. It's funny. I see this type of policy sold on a standalone basis a lot around travel. And I'll see clients like buy this specifically because, I'm flying. It's like, yeah, I know you're afraid of dying while you're flying, but the probability of someone dying in an accident is infinitely smaller than the probability of dying to health. And I know we don't like to think that way, but the reality is, we knew someone who died in a car accident or whatever it was, never in a plane one, but a car accident. But the reality is that this is when we want to see how low the odds of it happening are. Look at the difference in price between AD&D and life. Okay, for the exact same benefit, it's like 5-fold or something like that.
That's the reason the actuaries know the numbers. They look at they work hard on those tables, and that's why the AD&D rates are so low. Yeah, because the
odds of them paying out
of dying in an accident are fairly low. Yeah. And the dismemberment portion of that benefit, because it's an accidental death and dismemberment, let's not forget that pays a portion of the face amount, say in this case $100,000, it pays a portion depending on the loss. So the loss of your pinky may be 5% of the face amount. A loss of an eye may pay out 70%. It depends on the severity of the loss.
Which can be valuable because it could be one-time costs associated with getting that treated. I morbidly remember those pamphlets being handed out when I was in school to take to the parents. And it's just like, really, if I lose an arm, I get that kind of money? It doesn't seem like enough. I'm only a small kid, but even I know that. Anyway, let's move on. So I'm going to move on to what I consider the single most important benefit in the benefits plan, which is disability. And the reason I say that is because for the average person, especially younger ones, the most valuable asset they have is their ability to continue to earn an income. And without that, you're in trouble. And disability typically takes the form of covering you after 120 days is typically what we end up doing after EI stops paying. And depending on the plan, can be 2 years, 5 years, or to age 65 being the most common. So let's talk about what some of the key points around that are. So one of the big ones is who pays for it?
Well, disability, no one thinks we're going to become disabled.
And the odds state the opposite. Was it between 25% to 33% will experience disability at some point in their lifetime.
And I agree with you when you say it's the most important benefit. However, if you ask any employee,
they could care less.
They will say, the health plan, because that's where they see the dollars coming back in their pocket every time they go to the drugstore.
And the problem is, I'll tell you, when I sit down and try to, when I see a plan that already doesn't have a DI plan and the employer's not willing to pay for it, I say you should really make the employees pay for it. The pushback they give, because they only see the dollars out.
Well, the thing with the disability program is that, God forbid you were disabled today at the age of 30 and could not work for the next 35 years. How do you put food on your table? The disability program will not cover and replace 100% of your salary.
Well, and for the record, the Ontario Disability Support Benefit will only pay you a grand total of about $14,000 a year. Yeah. Right. And then CPP disability as well was another $1,000 on top of it.
If you can qualify for it, it's much harder to get CPP.
Absolutely. So there's a government cushion there. There's not much at one point, honestly.
No. And in fact, the disability programs all have what's called an 85% all source limitation. The reasoning behind that, for example, so if I have...
They'll make you richer when you're disabled versus...
They don't want you earning more money sitting at home doing nothing. So they will cut you back. So disability will give you... The general thing we normally see is 2/3 of your income to a max of $5,000 or $6,000 a month.
No,
So
the challenge here, though, is that those caps, I've seen caps now up to $10,000 a month, I believe, in some cases. Yeah. So, and that's more, I don't know when that started to happen, but I remember seeing them 20 years ago. But the big issue here is that disability is actually, we'll call it almost quote unquote discriminatory against higher income earners, because 2/3 of your income up to $5,000 or $10,000 is great for most people. But if someone is a highly paid executive earning multiple hundreds of thousands of dollars, and the maximum you could give them is 120 grand, that could be a fraction of their true earnings, right? And that's a massive dip in income. So we often put in place top-ups, individual policies for clients on who are high income earners well beyond what they have at work. Now, that being said, so the employer versus employee, let's go back to who's paying for it again, because there's an impact here.
Yes, there's two schools of thought. The premiums are not cheap for disability. Again, depending on your age and the demographics of the group, you can see someone with a $5,000 a month disability benefit may be paying $80 to $90 a month off their paycheck if they're paying it themselves. The employees push back. Why am I paying $90 a month for disability?
Yeah.
What they don't realize is if their benefit is $5,000 a month, if they're paying the $90 a month premium, if they do go on cover, they get the full $5,000 a month.
Yes, tax-free.
Tax-free. If the employer pays the premium, okay, when they get that $5,000 a month,
even a portion of it,
even one penny towards the premium, when they get that $5,000 a month benefit, it will be 100% taxable at whatever the rate is.
I know about you, but if I ever become disabled, I want to make sure it was as much after-tax income as possible. So therefore, tax-free works out a lot better.
Yeah. So we usually advise employers to have the employee pay the premium. That way, the benefit is tax-free. And what the employer can do is use that money that they would have used to pay the LTD premium to beef up some of the other benefits. Maybe increase the life insurance coverage. Maybe put in some critical illness.
And that's the next one. Let's move on to critical illness. So critical illness differs. Now, this confuses people because it differs from disability in that the disability's definition is you cannot work. You medically cannot work. Whereas critical illness, the definition is you have had this condition and survived 30 days. So the biggest culprits here are cancer, open heart surgery, heart attack, stroke, and surprisingly, MS is like 1% of claims. And then they'll cover, depending on the plan, it'll cover like another 20 conditions or something like that, including blindness and whatever. But those are really small. I mean, when you look at all the claims on this, 66% are cancer, but it's a lump sum. Now, what kind of lump sums are we looking at in terms of a payout on these?
It's not very high. Again, it's on a group basis. It's very difficult to get usually, but usually you see 25 to 50,000 as a lump sum payout.
Which isn't bad because when you look at some studies, the out-of-pocket cost of recovering from cancer in, say, Ontario is not far from that number over the course of 2 years.
Yeah, and bear in mind, it doesn't preclude you from still claiming WI, EI, LTD, it's a separate payout.
Yeah, but that being said, here's the interesting thing, and people get confused about this. Well, why do I need both? Well, there's plenty of people who have a heart attack and get an increased cost of living, but go back to work inside of 120 days.
Before the 120 days,
exactly. So they may get $0 from disability because they were back at work, but they now have an increased cost of living. So that's really what it's there for. It's to help you cover that cost. I would argue too, especially younger people, that's insufficient. We like to see amounts in the 100,000, 250 range, but it's better than nothing, quite honestly. Again, and some of these benefits, it's like, you know what, life doesn't fit. The life amount is not looking at your life and making sure it's the right amount. But the critical illness, same thing. The disability probably is okay, but may not. But you always have to make sure that the employees, first off, as an employer, this is great, you're providing this, but the employees need to make sure not only is it adequate to fit their lives, and if it's not, they need to create an adjunct.
Yeah, you're essentially just putting a base plan in to cover the employees. There is something there you can't cover off. It's the old 80-20 rule.
Absolutely.
Right? You're trying to put something in that's going to please the masses as best it can, and there's always going to be someone who falls through the cracks, or it's not enough.
Exactly.
And that's when the individual advisor comes in.
Absolutely.
And part of our job, my shop is strictly group benefits. That's what we do for the last since 1976. So part of our job when we go into renewals, or we look at the plan designs and we look to say, okay, well, these particular employees, the executives or this office class of employee, they need to have an individual agent come in and speak to them. And we will then call the agent or the sub-agent who is on that case and say, look, they've got 6 employees who need some top up going. And
absolutely.
Because we don't service the individual that well.
No,
that's not
what group is designed for.
Exactly.
It's designed for, like you said, the 80-20 rule,
yeah,
not the exceptional cases. So dental, moving on to one of the things that people think is the most important benefit they could have here. And there's an old joke about dental I heard for years is that it's not really insurance. It's basically money in, money out.
It's cash flow.
It's cash flow, right? Because basically the vast majority of people go to the dentist. The dentists know how much money they can take out of these things. And it literally is money in, take off the fees and taxes, money out.
It's a cash flow benefit.
Yeah. The argument is the only reason it's in there is because unions argued for it back in the day.
Well, that and a few other benefits too on the healthcare plan.
Fair enough. So let's talk about dental specifically first, though. So typically there's 3 tiers of benefits. So let's go through what all those 3 are.
Okay, so you've got your basic dental, right, which will be your X-rays, your examinations, etc. And then there's level 2, which would cover fillings and so on. And then you go on to level 3 and 4, which would be your crowns, your bridges, your orthodontia, the more expensive items.
And now one of the key terms we're going to talk about here is going to be called co-insurance, and the other one's going to be deductibles, right? So deductible is pretty straightforward. You have to pay a certain amount every year before the rest of it's covered. Co-insurance is that the employee's on the hook for a percentage of the total expense, right?
Correct.
And these are designed to contain cost or share some of the risk with the employee, correct?
It's also put in there to mold consumer spending. The way that we utilize the plans.
Don't just go to the single most expensive option every time.
Exactly. And it also helps to reduce the premiums. So the difference is deductible, usually you would see a deductible of a 50 single and 100 family. So in other words, if you're single, you go to the dentist, the first $50 in any one year, whether it's a calendar year or policy year, is out of your pocket. If you're a family, it's $100 per family. We are seeing these deductibles increase to 100 and 200.
Well, they're not correlated to inflation, right?
This is the problem,
right? So they're sticky. This is one of the reasons why I always preferred co-insurance amounts, because if the cost goes up, well, so does the out-of-pocket cost. So which one works better in your opinion? I have my opinion, but
I personally believe that co-insurance works better. The co-insurance for the uninitiated is where if you go to the dentist and your claim is $100, if you have an 80% co-insurance, it means that the insurance company will only pay back $80 out of the 100. You're on the hook for the other 20.
Yep.
So
doctor says that, hey, you could do this optional thing. You stop and think about, wait a minute, that's $1,000, $200 out of my pocket. Maybe I don't want the optional thing.
Yeah. Also, what happens is the employees that use the plan are paying a portion of it.
Yeah.
If you never use the plan or that portion of the plan, then you don't pay anything. So it's a bit more fair inequality in the way that it spreads the risk. And it does do quite a bit to reduce the premiums.
But in fairness, I mean, and this is the thing with most group plans, the vast majority of benefits are consumed, or the dollars spent are consumed by a smaller percentage of the overall group, right?
Again, the 80-20 rule.
80-20 rule, right? 80% of the money goes to 20% of the people. But
you can't get away from that.
No. So the reason I bring this up is because dental is the first of these benefits where this is an impact, right? We have to make a decision around that. So dental will come, we can design whatever co-insurance or deductible amount we want, but typically you're going to see, so co-insurance is between 50 to 0, right?
Right. We usually, the average we see is an 80% co-insurance.
Yeah. 50 doesn't really feel like a benefit, does it?
No, it's not a benefit.
So I always talk to people about the psychology of this, right?
The other thing that you'll see some companies do is that they will give 100% co-insurance.
Yes.
Nil deductible.
Yeah.
But have the employee pay some of the premium.
See, I'm not a big fan of that.
So they could do a 50-50 split on the premium.
I'm not a fan of that because I see that, to me, seeing that come off a paycheck every month is a reminder that you need to spend it.
It's a school of thought again, right? But it is an option. We see that less and less.
Well, you know what? I'll be honest with you. I find that when I go in to cases, to me, that reeks of the agent was trying to sell the biggest policy he possibly could because, I can only afford X. Well, he can only afford that. But if we put 50% of it onto the employees, 100% benefits the biggest possible premium, I get the biggest possible comp. So I'll tell you, as you can guess, none of my policies have zero co-insurance.
No.
So, but this impacts dental a different way, right? Because the 3 different tiers, they all have their own kind of maximums as well.
Exactly.
Right.
What you'll usually see is that level 1 and 2 may have a combined maximum of, say, $1,500 per person per year. And then when you get to major, that's usually a reimbursement of could be a reimbursement of 50%. And then when you get to orthodontia, it's usually a lifetime max of maybe $3,000 or $5,000.
But it's still subject to like a 50% typically.
Still subject to a deductible. Yeah. And also it usually only covers children up to the age of 19.
Yeah.
Very rarely is it for adults.
Unfortunately, no, adults who want braces are not getting it from the
Invisalign.
Invisalign or Smile Direct Club.
But dental is strictly dollars in, dollars out. And the problem with dental is, I won't say the problem, one of the issues is that the fee guide goes up every year. The Dental Association dictates what the fees will be.
Yeah.
So you can't go to your dentist and negotiate the fees.
No.
Okay. So what some plans will do,
unless you're paying out of pocket, then it's a different story.
But then you're not using your plan.
No.
So what some plans will do, another tactic to reduce your costs, is to what we call lag the fee guide. So right now, my plan where we work, our plan is on the 2019 fee guide. Okay, so if I was to say to our broker, which is myself, the renewal, the renewal's kind of high. What if we lag the fee guide by 3 years? Right? Let's go back and use the 2016 fee guide.
The most they'll pay on a benefit. It was a number from 3 years ago.
Right, which could be 60% less than now. So it's a way of shifting some of the costs back to the employee. So now I'm getting 80% of the 2019 fee guide. If I lag the fee guide, I'm getting 80% of the 2016 fee guide, which was 6% less.
And the real question is, does the dentist actually charge the full
This is
amount?
the thing, and the dentists...
Because they know this is this game, right? The dentists want to make as much money and they come up with their fee guide. The insurance companies want to keep this under control. So it's like, okay, you can come up with that price, but if these people opted to use the lower one, it's your choice as to whether you want to charge them out of pocket or not.
100%, and that's what happens.
Unfortunately, when you have indirect payer systems like this, it's not a true free market. And unfortunately, you don't get true clearing prices. You get some distortions, and then this is one of them.
It's a battle every year. I mean, we've seen things whereby a recall examination included your x-rays, your scaling and cleaning, and your examination by the dentist years ago.
Every year.
Now it's unbundled. You see the hygienist, that's one code.
Yeah.
You do the x-rays, that's a different code. So now by unbundling it, what used to be $108 now may be, depending which province you're in, could be $158.
I think we've all experienced this as subjects of going in and getting this done. So I bite my tongue when I see it sometimes.
The one thing I will say is that if you as an employee, now as the end user, go to the dentist and you walk out there with a claim form in your hand, or an explanation of benefits, an EOB from the receptionist, and you look at it and it says that you had 6 units of scaling, for example.
Yeah.
Okay. Think to yourself, were you in the chair for an hour and a half?
Well, let's discuss that. What is a unit of scaling?
That's right.
Yeah.
So were you in there for deep scaling for an hour and a half?
Yeah.
Then you question the dentist. Yeah. Or you see it's three fillings, MOD, there's different codes. I'm not expecting everyone to be up on the codes, but if you look at it and think, I was only in the chair for an hour.
Yeah. One of my clients is a lawyer in insurance fraud. Yeah. It's always an interesting conversation.
But it behooves us as the end user, as the consumer, to question the claim, question what's being done.
Absolutely.
We're scared to ask questions about doctors, about dentists, and we should ask those questions, substantiate the bill. If you go to a restaurant, you check the bill before you pay it with your credit card. And if it's wrong, I didn't have this hors d'oeuvre, take it off the bill.
This goes back again. It's an indirect payer system. We have something called moral hazard, essentially, which basically means that, you consume for lack of a better term, if you're not the one paying for it, you do not care about the risk anymore.
But at the end of the day, you are paying because if the premiums go up, even if the employer is paying the premium, there's less money for you to have a salary increase next year.
And it's interesting because in very small groups, when I've gone and set these up, I sit, typically there'll be a bunch of partners or something like that, maybe 3, 4, 5. And the conversation is had like, listen, guys, this is not a blank check. If you guys want to keep this beyond the first 18 months, you got to respect it and use it when necessary and make sure you're paying for what you should be, not just every fancy, none of you need a gold tooth anytime soon, right? So let's move on to the health benefit, which I will argue is the second most important benefit, even though everybody thinks dental is so important. So this entails a lot of different sub benefits when we break it down, right? So extended healthcare. Let's talk about the big one. Pharmaceuticals.
That by far is the biggest portion. If you look at a graph, if we were to graph the spend on any health plan, we normally expect to see the drug portion of around about 80% of the total expenditures on a group plan.
Yep.
For the health portion.
80%.
Up to 80%, which is huge. And what you'll then also find is that out of those medications being used, only about 20 to 30% of them now are the acetaminophen, the
routine stuff is tiny.
Routine stuff. It's now the largest dollar amount is the biologics. These are the big blockbuster drugs, which are $60,000, $70,000, $80,000 a year, but they only benefit 20% of the population.
And let's go back a step here. So the important thing for employers to know is that they're not getting hit with this full $60,000. This is being shared amongst all the premiums you're putting in for the entire group. And then beyond a certain threshold, it basically is applied to the pool of other businesses that you are in there with. So you're helping carry, this is all about risk sharing, right?
Yes.
That's what insurance is. So that risk is being shared throughout the entire group. But it's, some of these, I've heard VCs talk about like how to price these things, and I wanted to punch them in the face when I heard their line of thinking. But these things are only going to get more expensive. And, you talk about only benefiting 20, there's some of these things being developed that only benefit 1.
Yeah,
right?
100%. Like and that's the whole issue with the National Pharmacare. You've got some blockbuster drugs that may only benefit 1 or 2% of the population.
If we don't pool together and buy that.
Is the pharmacare system going to be paying those, that would be putting $3 million, for example, to cover 3 people versus that 3 million going to cover a lot more people for a lesser disease.
But let's just say, we switched that from 3 people. Let's just say it's 300, right? It's far more cost effective for the single buyer that would be the country to negotiate down the rate with the insurance. Like, this is why we pay less for drugs in this country in general, because we have fewer buyers, right? Yeah. Whereas in the States, like the same medication you would buy here for, can sell for 10x what it does elsewhere. And it's been pointed out in several subcommittee meetings. So pooling together does have, it's like Costco. You can buy your drugs.
Well, the insurance companies have realized over the years that the increase in medications is going up.
It's the only direction they're heading.
Going up. And also we're an aging population. So the usage is going up, not just the cost, it's utilization. As we get older, we use more medication. So to offset that affects premiums.
Absolutely.
Because it's dollars in, dollars out, plus their expenses. That's just like the dental, the health, drugs is the same thing. It's a cash flow benefit. And as I mentioned earlier on, when you get the renewal, they're not trying to recover what they lost. They're trying to project in the next 12 months that they won't lose it again. So,
which is why those trend lines are always up on the drug side.
So what the carriers have done is they will take you and your plan, and you've got 100 employees, and they'll say, okay, we're going to put in what's called a pooling charge or a stop loss. They use the word stop loss. There's all different acronyms they use.
But again, insurance on the insurance.
Exactly. So what they were saying is, okay, Jason, for your company, we'll have a stop loss of $15,000. So that means when any employee claims above $15,000 in a year, only the first $15,000 gets attributable to your experience. The balance goes to the pool. So if an employee claims $30,000, only $15,000 goes in your experience. The other $15,000 is forgiven from your rates and is charged back to the pool. That was fine for many, many years until these blockbuster drugs came out.
Yeah, because then it started blowing out. The stop loss was maybe used rarely. Now it's being used much more frequently. So therefore, it's that the money's got to come from somewhere.
So what they've done now is they've banded together the top 24, 25 insurance companies through Clear, and they've put together what's called the EP3.
By the way, we're going to include in the show notes a link to a document that Keith has basically given us that gives us, it's a cheat sheet on all these terms that basically agents use, so that you can basically have some idea of where we're coming from on some of this terminology.
Yeah. So you'll hear what's called an EP3 certification on a group plan. That's for fully insured plans. And what the major insurers have done is they band together and they've set up what's called simplicity, a super pool. And that is to protect the insurance company from going broke from high claims. So let's take an example.
So insurance on the insurance on the insurance.
It's like
now insurance cubed.
Yeah. Okay. So for example, so if I claim $60,000, okay, as an employee, the first $15,000 goes to my employer's experience. So he gets a rate increase based on that. The second $15,000 goes to the pool. Next year, I claim another $60,000. Okay, the same thing. The third year, if I claim $60,000, I can now attribute that claim to the super pool. So the insurance company is not on the hook for the full amount. They're only on the hook for, I can't remember the exact percentage of it. So they're reinsuring themselves.
Yeah, so they're making sure that these things are going to be around for a long time.
The reason is not because my claim of $60,000 is going to make them go broke, but when you look at the population, if they get 100,000 people at that, it's going to be
and if you're the unlucky company that has several of these, you're going to be in worst case. So again, this is one of those areas where that's how the insurance company is keeping things under control from their angle, which is good. So they're not just passing along 100% of usage to you guys. Basically, they're making sure that they're pooling risk themselves. So from the employer standpoint, this is another area where co-insurance and deductibles apply as well, right? So what are you most commonly seeing? Is it still the 80% of reimbursement?
We still say 80 is the most common. We're seeing some plans at 75. Usually we will see we'll see 100% reimbursement on things like paramedicals.
Yes.
Right?
So paramedicals, chiropractors,
but they have an annual limit, usually $500 per year per person.
Yeah. And everybody loves to get their massages done.
Yes.
One tip for you employers, do not have a massage therapist day where they come into the office. Like, you're just guaranteeing a bad renewal if that's the case. I've had to tell some people to stop doing that.
Actually, I've been in business for over 35 years, and we have a few anecdotes. I mean, one of them I can say is that we audit the claims of our clients every year. Yeah. Not the individual names. We don't get the information. But in general. And we identified a few things. One thing we identified was one client that there was an influx of TENS machines, these Dr. Ho units. We couldn't figure out why. So we go back to the employer at the renewal time as we're going through the claims. Here's what we've analyzed. The increases, but it's attributable to this huge dollar amount. Like, it's crazy. What happened? Oh, we had a health fair. We called in the chiropractor. Yeah. And he said that these TENS machines were covered under the plan. So everybody got one.
They are. But again, this is the problem when people think it's free money, right? Like, and I had a group where basically they had a massage therapist in every Thursday. And first renewal came up. I'm like, you have a what now? Okay. So tell them never to come back. Because, like, here's the thing. This is meant for people who need it. If you basically need routine massage because because whatever, you're in a stress position, posture, you've had an injury, whatever it is, you're going to seek that out. And that's what it's there for. It's not meant to be there for, oh, this is convenient and it's kind of nice, right? So I'm going to totally do this, right? So like, let the people who basically need that benefit utilize that benefit. Don't try to come in and sell it to everybody because, again, it's not free money.
It's not free. And that's people don't realize, if you read the booklet, your employee booklet, it will say medically necessary.
Absolutely.
So the insurance company could have to come back and say, 15 TENS machines were sold to your employees from this Dr. Jane, blah, blah, blah.
Out of 30 employees at this company.
Were they medically necessary? Let's see. Now they can then go, I don't know whether they've done that, but they have the right to come back and charge it back to you.
And so I mean, it's important that, again, we use these things appropriately to contain
cost. Is it fraud? Is it benefits fraud?
We see stuff about benefits fraud more and more in the news these days, right? So all said and done, so we're looking at the big one's drugs. We also talked about paramedicals. I see some people some employers get annoyed thinking, it's just massage, whatever. Like, no, this is a lot of stuff in there, chiropractic, orthotics. There are things that
speech
therapy, therapists, like that is important.
Social worker, psychiatrist, psychologist, acupuncturist. Can't even say that word properly. Acupuncturist.
Like these things are important to those who basically have those conditions. So,
naturopath is another one. Alternate medicine. Yeah. And we find the millennials go a lot more for that because rather than taking a drug, they would sooner go to a naturopath, or they would sooner go to physiotherapy rather than.
Well, they should fix a problem. But anyway, the point is that so physiotherapy I do condone. Naturopath will bite my tongue. Anyway, so let's move on. Also, one last thing in there. Also, hospital visits are in there, right?
Hospital visits.
Nice to know that.
Here's the thing with hospital: it's actually semi-private coverage
by default,
or private coverage. Okay, there's a premium for that. The question is, as far as I understand it, if the doctor recommends that you as a patient require private or semi-private room, OHIP pays for it. So really, you're now only covering semi-private or private for those that are deciding to have it. Yeah. And usually it's for pregnancy. If you can even get a room in Ontario.
In fairness, I've seen the 4-to-a-room systems. I'm just like, or 6-to-a-room systems. I'm like, there's a lot going on here. I would never be able to sleep. And now I value semi-private and private more.
If you can get the rooms.
If you can get the rooms.
Well,
and we think about, we can get into the good and bad of that. So one of the things that's separate from this, but kind of part of it and an adjunct is travel. So there isn't a year that goes by where I don't see something on the news about someone saying no to travel insurance when they bought the trip to the Dominican and then they get injured and then there's got to be a GoFundMe campaign to get them back to Canada. Okay. So first off, always have travel insurance, even when traveling between provinces. Okay. Because we have provincial healthcare. You go to another province and you incur a bunch of costs that are not covered because you're non-resident of that province, they're going to whack you with it. There was a case a couple of years ago with an air ambulance where they had to move a woman because of a high-risk pregnancy. It was a $160,000 bill. She was in Ontario visiting from Alberta. Once the news got involved, they split the bill, but they were going to stick her with a $160,000 bill. You go shopping in Buffalo for the day, you're traveling out of country. So what's the conventional limits we see on these things in the group plans?
We used to be plans used to be $1 million, $2 million lifetime, and they would usually be back then up to 180 days out of the country. Well, the carriers got wise that you've got the executive who's now taking 4 months in Florida, technically not working. So now most plans now are 30 or 60 day trips out of the country. Yeah, which is even.
So they come back for a couple of days and then go back
again. Yeah.
Now, one important thing to note here. So first off, it's important that everybody's got this. So group plans, great for providing, because that's where most people get it from. So if you have this on your group plan, also do not check yet. You're the only person who's allowed to not check yes to the travel insurance on the purchase. So one of the things that people aren't aware of and you have to be careful of is that there's a period of stability required before you go, right? And that's another thing I see in the news where someone will like, I had this, but then I had surgery on the Tuesday and then I went to the Caribbean the next day. And lo and behold, there was a complication.
Right, that's true. But with group plans, usually because there is no health requirement on the group as a whole, usually you'll see wording such as not traveling against the advice of your doctor, unforeseen, medically unforeseen emergency, right? So for example, from that point of view, so whereas if you get the individual products, I won't name any carriers, but they would actually have a clause in the saying, if you have seen a doctor for this disease or this thing in the last 30 days or whatever you're considering, and it's much more restrictive. But the group plans are not quite as restrictive around. Doesn't mean they don't have a pre-ex clause.
You still have to basically be stable before you travel.
Not exactly.
But you can't. But you're not going to have that question to qualify in the first place.
And I would say to anybody as a caution, when you're booking online with nothing against Air Canada or WestJet or any of the airlines, they always come up with that window. Do you want travel insurance? You check yes, and they sell you the policy.
The problem or talk to your advisor. advisor and make sure they have one that's vetted.
The problem there with that type of policy you're buying, even or any of these ones which are online, is that they're not underwriting you. You get underwritten at time of claim. So you think you've got coverage because you purchased it, but when the claim comes through, that's when they delve into your
There are
history.
a couple of ones sold through agents that you can't, like we do, that basically are underwritten. The other one I will say too is the number of times people say, I have it through my credit card. You ever read
Same as the ones you buy online. The best thing for travel insurance, if you're not covered under your group plan, contact a company like ours or an individual agent who will actually underwrite you. The premium may be higher, but you know exactly your coverage. We've got coverage for someone who had a heart attack 30 days prior. Yeah. And we got them coverage.
Going back to the credit card, one last thing to beat up on there. And if you're an employer listening to this and saying, I have it through my credit card, here's the reality of it. You ever read the terms of your credit card? I've seen quote unquote, travel cards that had travel insurance totaling a grand total benefit of, guess what? $25,000. I've seen them lower to $5,000, but a travel card one time, $25,000. $25,000 in the US won't even get you to the hospital. Like it's astonishing that they had the audacity to market as such. So know that, typically when we do these plans, we see either no mention of a cap, but reasonable and customary amounts being acceptable, or lifetime caps in the $1 to $2 to $3, $4 million range, right? And anyone who's looked at the cost of medical care in places like the US understands why. So going back over the plans, okay, there's a couple of mandatory benefits, which were life and ADD. Everything else is kind of basically optional, but of course you're going to want to do at least health is pretty much the biggest reason employers put this in place. The rest of it comes out there. There's a couple other smaller additional benefits that are valuable and nice to have. One of them is an employee assistance program. So let's talk about what that is.
Okay, employee assistance programs are, well, I won't say they're fairly new. They're one of those things which are in the background. You really don't know what the ROE is on those. I mean, they say for every $3 you invest, you get $5 back at the end of the day. An employee assistance program would be a hotline, a 1-800 number. I'm feeling depressed. I don't know where to turn. I can call the 800 number. They would do some form of an intake and then maybe recommend a therapist for me to go see, or a course of action. Or it could be
smoking cessation
treatment. Or it could be I've got an elderly parent and I can't go to work because I'm so stressed out. It's causing me issues or whatever. They can guide me through to an elder care program, things like that. So these things are more preventative measures, and they're not expensive. For an employer to put an EAP in, anywhere from, depending whether you go on a standalone product or one with an insurance company that's built into one of their health plans, anywhere from $2 to $5 per month per employee.
Yeah, I think they're valuable. I mean, the number of times I've had people who needed some sort of psychological counseling just because of whatever was going on in their lives at the time, and being able to say, okay, look, first off, you have navigation services through the AAP at work. And in addition to that, you also have X number of hours paid for through this program. So do not hesitate to use it. There's no, when you take out the cost factor and you take out the I don't know where to go, it becomes incredibly valuable.
Well, the offset here is the thinking is that if you can get somebody to use an EAP, you've got someone who's coming into work every Monday with a hangover. After 4 months, you have to, maybe there's a problem on a Sunday night, they're drinking too much. And if the supervisor can get them to go to the EAP, alleviates that might
prevent claims.
It may prevent health claims and also a disability claim down the road. So that's where they come up with this idea. If you put $3 in, you get $5 back on your bottom line.
With workplace productivity and basically just your ability to attend.
You get more you get away from this presenteeism.
Absolutely.
I'm showing up for work, but I'm not really working because there's a background issue.
Yes, it is. So another, newer, nicer to have is second opinion services.
Yes.
So let's describe what those do.
Okay, second opinion services are even an embellishment on an EAP in that they take various forms, but essentially, if I go to the doctor and I get a diagnosis of, say, I'll use cancer, for example, and he refers me to an oncologist, and I'm now got a 3-month wait for an oncologist. I can then go to the second opinion provider, and they will then assign a nurse to me who will then get all of my records from my existing doctor, go through that, and usually send it off to one of their centers of influence, depending on the provider. It could be the Mayo Clinic, could be the Cleveland Clinic, could be Sloan Kettering.
But typically one of the top ranked individuals.
Right, exactly.
There's one company specifically that actually surveys like everybody in every specialty field and says, if you had that specific thing that you are, the specialist at, open heart surgery, if there's one doctor that you would put your life in the hands of, who would it be? And they basically rank him based on that. And then the person who wins that poll ends up getting all that case
Exactly.
work.
So they send all the case files to that doctor who may have seen your case 60, 70,000 times in his lifetime, or his clinic may have done.
So you're getting a second opinion from literally probably the biggest expert in the field.
In that field, exactly. Yeah. And then they would come back and say, well, your oncologist was recommending that you do this. However, we know that, this is what's needed.
Oh, some of the crazy cases they have from like people being diagnosed with cancer and it was just an acute allergy, or Parkinson's and it was just a nerve issue in the neck that could be regulated with surgery. Like it's some of the stuff that they've had in the past. I tell you, we always hear you should always get a second opinion. Typically that means going to see another doctor. But frankly, if I can get literally a second opinion from the biggest authority in the world, I'm getting it.
Yeah, I mean, we have one second opinion provider that we deal with, whereby if you can't get the opinion or referral, I think it's within 30 days in Ontario, they will pay to get you to the next province to get the
really
approval.
Wow.
Yeah.
Fantastic. Yeah. So, and that's also a very nominal cost, right? We're talking a couple of dollars.
Again, $5-6 a month per employee. Again, there's always buy-ups. If they want to buy up the actual insurance to actually pay to go to the Mayo Clinic after the fact, you can buy insurance for that. Fair enough. It's like anything, right? You start with the base.
Yeah, I have one of those also too. It pays for me to go to the Mayo Clinic if I need to.
But some of them are it depends, not for everybody. It depends on your stage in life.
Oh, no. These things are not, those are, I mean, we have a great system in this country. And frankly, no one has to worry about going bankrupt for getting sick. But for those who want alternatives outside of what we offer, maybe faster service, there's options. And there's policies that'll pay for that.
Well, everybody likes to jump the line. We all think we're special.
Don't we all?
And in Canada, we can't jump the line like they can in the US.
Yeah, well, I'm talking about that later. So the next one I want to talk about is health spending accounts. Yes. So this is not really so much of a benefit. This is something that gives employees discretion. So tell me about it.
Okay, well, there's two schools of thought here. We've had employers come to us and say they want to put a spending account in. A spending account is a bank of money that you put aside for an employee to spend how they wish on benefits up to a certain level. So, for example, I might say, okay, I'm going to give every employee $2,000 a year to spend on healthcare as they see fit. There's certain rules around it under Revenue Canada for
not everything qualifies.
Right. It has to be items that will generate a credit, medical credit, under income tax.
Like, for example, like vitamins are the big ones excluded from
over-the-counter medication. Drugs will not be covered. And also there has to be an insurance element in there. So you think, well, hang on a second. If this is money the employer is giving to me, in order for it to remain tax-free to me as an employee, it has to be an insurance element. How do we get that? The definition of the insurance element is risk. So if I say to you, Jason, I'm going to give you $2,000 a year to spend on healthcare as you wish, the risk is that if you don't have $2,000 worth of expenses,
you don't get the money.
You lose the $2,000. Yeah. Or the other risk is that you have $4,000 of expenses. You can only claim back $2,000. Yeah. So there's the risk. Yeah. So that covers off the risk factor. And to ease that as well, what Revenue Canada allows you to do is that if I give you $2,000 a year to spend on healthcare and you spend you spend $4,000, you can carry forward the $2,000 that you couldn't claim
into the following year,
into the next year, up to 1 year. And the same with the money. If I've spent only $1,500 out of my $2,000, I have $500 left. I can carry that forward to next year, but only for 1 year. If I don't use it, I lose it. So there's the risk element. Yeah. If you do that, then you can set it up.
But to an employee standpoint, basically it's discretionary money that can be used to, say, cover off coinsurance, deductibles, whatever it might be. Or sometimes I see it just replacing outright benefits. I've seen it replace dental benefits. I've seen it replace paramedical benefits. It's not an apples to apples comparison.
It's not an apples comparison, no.
Because I mean, once you use it, it's like, well, that's the end of that.
Well, here's the thing. We've had employers come to us and say, we want to put a spending account. Everyone's talking about a spending account. We want to put one in. Can we cut out the dental plan? I use a spending account. Give everyone $2,000. I said, oh, sure, you can do that.
That's fine, but the dental plan covers more than $2,000.
I said, here's the thing. You have a family of 4 people, each with $1,500 each. That's $6,000 a year on dental. If you only put a $2,000 spending account in, you've just cut that employee's benefits. So we'd say a spending account is not a replacement for, it's an add-on. It's a perk. It's a bonus.
So, and that's a health spending account. Now, what we've starting to see is some providers provide spending accounts for basically non-health related business.
A
wellness account, right? So, you want to cover wellness related things such as your gym membership, or, you've run basically other things.
Hockey sticks, golf shoes.
Yeah, anything related to wellness.
Yoga classes, anything.
Dog walking I've seen done. At the end of the day, wellness is an interesting term used for that, but that people don't realize that is a taxable benefit to them. So really, it's not much better than the employer paying them more cash, but it's got this nice little stigma of like, oh, my employer's paying for my gym membership.
Exactly. It's the optics.
Yeah, it's optics. I mean,
right?
Like literally, if you explain, if I've had people come to me and say, oh yeah, it's great they pay for all this. I'm like, well, let me explain how this works to you. And they're like, oh, so they could just pay me more money? Yeah, basically.
It
but now you can only spend it on this.
It goes as a taxable benefit.
But it is good though, because it can encourage certain actions, right? It encourages, I can only spend this on my gym and recreation, like because you can limit the type of things.
You can limit. Yeah, some companies do, some companies don't.
Yeah.
Right?
So if you limit to recreation solely, then you're helping, basically saying if you're going to live an active lifestyle, I'm going to support that active lifestyle.
And the difference is too, by putting it into a spending account, you're not actually physically giving the employee an increase in pay.
No.
You're giving them an allotment of money to spend. Again, the same thing. If he doesn't spend it,
you don't pay for it.
I haven't paid for it. And just one caveat with the spending account, the health spending account, we can do structured or unstructured.
Yeah.
Structured means that we will cover only certain items out of that account. So, for example, our plan does not have vision care. So we can say, okay,
we'll talk about vision in a second. So
you can say you can use it for vision care, or you can only use it to top up your dental, but you can't use it to go to the chiropractor 6 more times.
Yeah. So vision is typically embedded in the health benefit. And I too hate vision because I know it's a profit center, right? So what are we typically looking at in terms of benefit versus cost?
Okay, so vision care, most plans will cover an eye exam once every 2 years.
Yes.
Up to a reasonable customer, which I think is about $85 in Ontario.
But then when it comes to glasses.
If you want the glasses and the contacts, that is a separate benefit. And they call it vision care. And it's usually structured that would be $150 to $200 every 2 years.
But meanwhile,
or every year for children under 18.
Yeah. But what's it costing the actual employer?
So the premium could be $6, $7 a month per family. And bearing in mind, you can only claim once every 2 years. So it's cyclical. So what happens is the premiums are going to show that every year you're going to get an increase.
Yeah.
Because again, it's dollars in, dollars out. Quite often the employer is better off to self-insure that.
Exactly.
That portion.
Yeah. I've said that for years is that, it's nice they pay for your glass. You want to pay for the glasses, but you're better off just giving them the money.
And quite frankly, what glasses can you buy for $200 every 2 years?
Clearly contacts.ca.
But even contact lenses cost you $100.
Don't get me started on the monopoly that is Luxottica and how this actually exists in this world. It's astonishing. But yes, this is why I shop at Clearly, or what's the other one? It's Warby Parker. Okay, so we talked about all the different benefits, and that's fantastic. One of the things we want to talk about is kind of the concept of almost like acting as the insurance company yourself to some degree. And this is something called an ASO, or Administrative Services Only Plan. So when we think about it, the money goes to an insurance company for all your employees. They pay money out of the benefits out of that amount, and they hope to hold on to a certain amount of it. And they have a stop loss ratio stop loss insurance in case things get ugly.
Correct.
The employer has the option of doing the same thing, right? So let's talk about what that looks like, what the benefits are.
Usually we're talking self-insurance is usually only on health or dental.
Yes.
Okay.
Yeah, you can't do that with life.
You don't want to self-insure life insurance because
disability,
because one claim would devastate you. Okay.
Well, disability claims.
And also there's a threshold. I mean, there are companies out there that would do self-insurance for companies as low as 9 or 10 lives. And for me, it doesn't make any sense. You're better off to say fully insured. Self-insurance essentially is saying, okay, let's look at the premium that an insurance company wants to charge us for the year for health and dental. Say it's $300,000. We say, fine, okay, what are our expected claims based on our population? So we go back and look at the history of your claims for the last 5 years. And based on the current trends and the inflation factors, we say, okay, your claims for the current year, projecting forward, are going to be $230,000.
Yep. So $70,000 wiggle room.
You got $70,000 left. So we say, okay, for $70,000, can we purchase the service of an administrator to process and pay those claims?
Because you can't do that as an employer because of violation of privacy.
Exactly.
I see that happen several times where people are like, what if I just give them money in exchange every time they bring me a receipt? I'm like, well, you just broke the law.
Yeah, it's privacy, yeah. So you would hire a company, one of our companies does this, where we actually administer and pay the claim. So just like an insurance company, but instead of giving the money to the insurance company every year, you're putting it into a trust account. And every month, so the employees send in their claims, just like they would to an insurance company, process it the same with a drug card, the same way. The claim will come into our office or a company like ours. We then pay the claim out of your trust account and deduct all the expenses and taxes from that. At the end of the year, do a reconciliation. So if you had $300,000 in the trust account, but only $380,000 came out, claims and expenses, you as the employer are better off by $20,000.
Yep. And you don't make that contribution the next year.
Exactly. The caveat is if the claims are more than projected, you've now got to pony up the money.
But
there's the risk.
There's such a thing as stop loss insurance.
We can put stop loss in there. Again, stop loss is the same as insurance company, but it's usually based on a per employee. So an employee, say, claims $15,000, but the stop loss is $20,000, only $5,000 gets paid by the stop loss insurance company.
So so they're not insuring the pool, they're insuring each individual employee.
Exactly, up to a specific limit.
But nevertheless, I mean, it still protects you from the massive claims from, so if everybody uses the basic benefits up to the threshold of the stop loss, to a greater degree than expected, then yeah, you're on the hook for that, right?
Right.
Now, that being said, I mean, this is how insurance companies work, but the reality is that if your workforce is relatively stable and you have a large enough population that those things even out, then you're okay to do that with very little risk.
Yeah, there's a few caveats. One of the caveats is that there are fewer and fewer stop loss providers.
That is a known problem.
Willing to insure a standalone self-insured plan. When the insurance companies do a self-insured plan, they're using their own stop loss. They're their own insurer. So by going to a third party, you've now got to find a stop loss provider. We have providers in place that we can use, but they drop in and out of the industry.
We were down to like one point, weren't we?
We were back up to about 3 now. The problem problem is, as they incur claims at the stop loss level, their fees go up, right? Their rates go up.
There was
so that throws the whole mechanics and the estimates out of the window.
But it's still, here's the thing, it's not perfect, but still could be a cost-saving measure for employers where it's the right fit.
The other major issue is this, we talked about the EP3 protection in the beginning.
Yes.
That does not apply to a self-insured plan.
Correct.
It only applies to fully insured because the insurance companies have the risk.
Which is a risk that people don't understand. And frankly, if you're not in the industry, nor should you actually understand it, but you're not getting an apples to apples comparison.
Exactly. So the problem is now, if we put a self-insurance plan in and you're going fine for 3 years, you're saving $10,000 a year or whatever the percentage might be, and in the 4th year, your claims go through the roof. You say, you know what, Keith, I want to go back to fully insured. Mm-hmm. I can't, my workforce has changed, my demographics have changed, I've got older employees, my claims are going higher, I can't find stop loss anymore, I want to go back to fully insured. The insurance company's going to say, okay, where's the EP3 certificate?
I don't have one.
We don't have one because we don't qualify.
Yeah.
Now what happens? They will rate you as a virgin new group. Yeah. And what will happen is at the 6-month mark, they will take a look at all the claims, and anybody that has a claim for a medication that is ongoing, expected to be over $15,000 a year, they exclude them from the from
so
the group.
Guess who's on the hook for that?
So now you're on the hook for those employees directly.
Yeah.
So
it's not without risk.
ASO is good for the large, in my eyes, in my opinion, is good for the companies with 1,000, 2,000, 3,000, 4,000 employees where they can mitigate the risk. At the smaller level, I personally don't agree with
I mean, here's the thing: those drugs are not an everyday occurrence, but when they happen, again, this is an employer risk, right? Like I was at a conference recently, and someone got up talking about how he was doing it for groups as small as 3, and I like to respect the guy, but I don't think this is something that they thought out quite the way they should have, because frankly, if it's a 3-person group, and let's say one member is not family or 2 members aren't family, and the one person gets on the hook for, like you said, $50,000 a year in insurance claims, you're on the hook, right? That's pretty rough. So, I mean, this is, of course, something that's been used by large companies like the banks and whatever internally for years, right? Because they're large enough, they can pull the risk.
They can pull the risk. So we've had groups, of 30, 40, 50 lives on it, and we kind of shut it down. Once EP3 came in, to us, it didn't make prudent sense to put the employer at that kind of risk.
Yeah, well, good on you for being stewardly in that regard. So before we close up, any design tips? I mean, any tips for cost containment? To me, it's all about risk sharing. When I talk to clients about people about this, and spending money on what is necessary, right?
Well,
not the stuff that's more fancy.
Yeah, I mean, for us, I mean, there's still a few benefits we didn't touch on: group RSPs, profit sharing plans, retirement plans.
The retirement savings is another conversation. I'm bringing someone else in for, my friend. Sorry, you got the insurance, okay? You got the risk side.
But there's so many things that you can add into it. And as far as cost containment, one of the biggest things that we like to do is educate the employees. Hold lunch and learns with the employees. Yep. Tell them what the benefits cost. Yep. They have no idea how much you as the employer are paying. It is astonishing. And here's a tip for employers. Okay, one of the things that we do here is when we do their salary renegotiation every year, or basically give them their increase, we actually break down the total expense to the company on one sheet of paper. It says, okay, yeah, here's your salary. Here's our end of CPP, our end of EI, your cost of your benefits, anything else we do, and things where they're like kind of perks, we put them down as, intangible benefits, whatever, right? I'll tell you, it's a very different conversation when they think, oh, I'm making 50 grand, you guys should be paying me more, to, oh, wait a sec, you're paying me 50 grand, but with everything else, it's like $58,000? Really? Like, okay, so I'm technically costing you more than I thought, right? So it's a very different conversation come the time. And it's the number of people I've met who've left their employer and said, yeah, I want to replace my benefits. And I give them the quote and they're like,
are you out of your mind? You're crazy. You're trying to gouge me. I'm like, no, this is what your employer was paying roughly.
Yeah. No, it's very important. I believe you have to educate the employees because they're the consumer. They need to know what you're paying for and how to use it. I mean, we teach the employees how to look for fraud themselves and their providers. I'm not saying every dentist and every pharmacy is fraudulent.
There are bad actors out there.
You can go to some pharmacies where the markup is much higher or the script fee is much higher. So why would you do that? Because that all affects the plan. We had one client many, many years ago was a nursing home, and their physiotherapy and massage therapy was unlimited. And you can guess, they're all nurses. So they were going for massage and physiotherapy. It was a union plan. Most plans, at the time, OHIP covered physiotherapy. Yeah. But you had to wait to get into a clinic. So we recommended to the union and to the employer, in order to contain costs, limit the physiotherapy to $500 and let the employee go to OHIP. They use the $500 by waiting for the OHIP clinic and then
if it's medically necessary.
That would have saved that plan. I'm trying to think of the numbers back then. I think it was something like $40,000 a year.
Guessing the union fought back.
Right? Union said no way. They would not do it. We met with the union 3 times. They wouldn't budge on it. That nursing home is out of business. Because that saving would have been, they could have hired another nurse. Savings. It was jobs. They said, the union said no.
Well, that's thankfully not everyone's a union shop, or not all unions are that short.
So you have to. So I think it's important to educate your employees on what they're covered for and how to use it wisely. Yeah. And that's the reason you have the benefit program.
And making sure that they understand enough so that they don't treat it like a blank check. Like that's a frustrating thing. Perfect. So where can people find you, Keith? Because now we're wrapping up. What's if they want to talk to Keith Foot?
Okay, well, that's a good one. We have a website. It's ralphmoss.ca, RALPHMOSS.ca. That's our consulting side. Been around since 1976. And our administration company is Automated Administration, which is AASINC.ca, and that's been around since 1985.
And there will be links in the show notes and the transcripts, so people will be able to find it. So thank you very much for taking the time.
Thanks, Jason. Anything else, just give me a call.
Will do. So that was my interview with Keith Foot of Ralph Moss Insurance. I've been working with them for several years, and I highly recommend them. Although if you want to talk to me about your benefits, I'm also here as well. So as always, this is Jason Pereira, and this has been the Financial Planning for Canadian Business Owners podcast. And if you enjoyed this podcast, please leave a review on iTunes, Stitcher, or wherever it is you get your podcasts. Until next time, take care.
This podcast was brought to you by Woodgate Financial, an award-winning financial planning firm catering to high net worth individuals, business owners, and their families. To learn more, go to woodgate.com. You can subscribe to this podcast on Apple Podcast, Stitcher, Google Play, Spotify, and SoundCloud. For more episodes, go to jasonpereira.ca. You can even ask Siri, Alexa, or Google Home to subscribe for you.